Welcome to a deep dive into the world of Indian finance. Specifically, we're going to be looking at the Q3 FY25 earnings call of EQA Small Finance Bank.
Okay.
We've got the earnings call audio and the presentation slides. And today, we're going to unpack how this bank, which is really known for serving India's informal sector, is handling a little bit of a roller coaster ride.
Yeah, it's a really fascinating case study. I think we're talking about a sector that's facing some headwinds right now, and EQA's performance, I think, offers some valuable insights into how they're managing that.
Right. And I think the story really kind of starts with microfinance, which is EQA's traditional stronghold. The bank's MD and CEO, Mr. P. Navaswan, actually mentioned on the call that some cracks began to appear in Q1 FY25.
Yeah, one of the key indicators, I think, of the trouble was their collection efficiency.
Yeah.
Think of that as like a measure of how effectively they're getting borrowers to repay their loans.
Uh-huh.
They usually boast a really impressive, like 99.4% efficiency, but that number took an unexpected dip to 98.9% in Q1.
Okay, that might not sound like a huge drop, but for a bank that's really reliant on microfinance, I imagine that's a pretty significant shift.
Absolutely. And by Q2, it had actually fallen even further to 98.2%.
Oh, wow.
So you can really start to see a trend there.
Yeah, so this isn't just a couple of isolated incidents. It sounds like it was more of a systemic issue.
Yeah, and here's the kicker. This wasn't just an EQA problem.
Oh, really?
This was happening across the entire microfinance industry in India.
Wow. So what was at the root of this industry-wide kind of dip in collection efficiency?
Well, one of the main culprits seems to be over-leveraging.
Okay.
It turns out that a significant portion of borrowers, around 10 to 15%, were taking out loans from multiple lenders, sometimes three, sometimes even five or six.
That's a lot of debt to be juggling. Wasn't there a rule in place to prevent this kind of overborrowing?
There was the Microfinance Institutions Network, or MFIN, used to have a cap on the total amount an individual could borrow from MFIs. It was set at INR 1.05 lakhs. And this was really meant to protect borrowers from taking on more debt than they could handle.
But then in 2023, that cap was removed and replaced with a new limit of INR 2.25 lakhs.
Exactly. And while that might have seemed like a good idea at the time, it's likely contributed to the current stress on those borrowers. Suddenly they had access to a lot more credit, and some may have taken on more than they could realistically repay.
It's like giving someone a larger credit card limit without considering if they can actually afford to, pay the higher balance.
That's a good analogy. And then to make things even more complex, you have the rise of app-based lenders.
Right.
These apps offer small, short-term loans, often in the range of like INR 5,000, INR 25,000.
Okay.
And the ease of access and the quick dispersal can be really tempting, but those short repayment periods can really put a strain on borrowers, especially those who are already juggling multiple loans.
So you've got this perfect storm, brewing relaxed borrowing limits, easy access to credit through these apps, and then potentially just a lack of clear understanding on the borrower side of what the implications of taking on all this debt can actually mean.
Right. And for EQA, this kind of manifested in what they call their X-bucket efficiency.
And can you explain what X-bucket efficiency is for those of us who aren't immersed in, banking jargon?
Of course, X-bucket refers to loans that are overdue by more than 90 days.
Okay.
So X-bucket efficiency basically tells you how well the bank is doing at managing these seriously delinquent loans. And as you can imagine, with the overall stress in the microfinance sector, EQA's X-bucket efficiency wasn't looking too rosy.
Yeah, so while their X-bucket efficiency did show some signs of stabilizing in Q3, it's clear that this microfinance stress is going to have a lingering impact.
Absolutely. The CEO actually acknowledged on the call that they're anticipating elevated credit costs for their microfinance business for at least the next few quarters.
Right.
These are costs associated with managing bad loans, and they can really eat into a bank's profitability.
So you might be thinking, well, this all sounds pretty bleak for EQA. Is this the beginning of their downfall? But that's where things get interesting. EQA saw the writing on the wall years ago and started diversifying their loan portfolio. And that may just be their saving grace. So EQA saw this microfinance storm brewing and started diversifying. It makes you wonder, how long have they been at this?
What's interesting here is that EQA's diversification journey actually began way back in 2011. So it wasn't a knee-jerk reaction to recent events. It was really part of a long-term strategy.
Wow, that's impressive foresight. So give us the numbers. How diversified is their portfolio today?
As of Q3 FY25, microfinance makes up just 14% of their loan portfolio. The remaining 86% is dedicated to secured lending.
86% secured lending. That's a pretty substantial shift away from their traditional microfinance focus. What kinds of secured loans are we talking about?
Yeah. They've got a pretty diverse mix, actually. small business loans, affordable housing loans, used vehicle financing, and loans for micro and small enterprises, or MSCs. These are all generally considered lower risk than unsecured microfinance loans because they're backed by some form of collateral.
Right, that makes sense. If a borrower defaults, the bank has something to recover their losses from. But the skeptic in me is still curious about the performance of these secured loans. Do they actually hold up in practice, especially in India's informal sector, where things can be a little unpredictable?
This is where it gets really fascinating. EQA has this product called Microloan Against Property, or MLAP. They introduced it back in 2012-13, specifically to provide funding for small businesses, in the range of, say, INR 2 lakhs to INR 7.5 lakhs.
So essentially, small business owners can use their property as collateral to access larger loans. Makes sense. But how risky is that for the bank?
That's the surprising part. Over the years, they've had over 2.3 lakh MLAP customers, and out of all those borrowers, only 690 cases ever required legal action to repossess the property.
Hold on, only 690 cases out of over 2 lakh customers. That's a remarkably low default rate.
It is, and it gets even more impressive. Out of those 690 cases, they only actually had to sell 23 houses. That's less than 0.01% of their total MLAP customers.
That's astounding. It
Yeah.
sounds like their underwriting process for these MLAP loans is incredibly robust. They must have a really effective way of assessing risk.
Their track record certainly suggests that, and now with the slowdown in microfinance, they're strategically doubling down on MLAP. It's almost like they're using this current challenge as an opportunity to further refine their portfolio and focus on what they do best.
So it's not just about reacting to the microfinance situation. It's about leveraging their strengths and accelerating their long-term strategy.
Precisely. And this brings us to the core of EQA's long game, building a stable, sustainable, and scalable model for serving India's informal sector. They're not just chasing short-term profits, they're building something with a much broader vision.
Okay, so we've seen how EQA is navigating this microfinance challenge while simultaneously building this, strong and diversified portfolio. But I'm really curious about this long-term vision that they mentioned. What's the grand plan here?
Well, EQA has been very clear about their long-term objective. They're aiming to build a stable, sustainable, and scalable model. And what's really fascinating here is their focus on the vast unmet credit demand in India's informal sector. This is a space where traditional banks have often been hesitant to enter.
So they're positioning themselves as the go-to financial institution for this massive, underserved market.
Exactly. And they have the experience to back it up. I mean, their products have been tested for over a decade. They've weathered various economic storms, GDP slowdowns, demonetization, even the pandemic. And through it all, their credit costs for their non-microfinance products have stayed within acceptable ranges.
Right. They even mentioned affordable housing finance, which they expect to actually break even next year, despite not being profitable yet.
Right. And that's a key part of their strategy, building a diverse and resilient portfolio. But they're not just focused on assets, their lending side. They're also making some really innovative moves on the liability side, their deposit strategy, which they call Liability 2.0.
Liability 2.0. That sounds intriguing. What's the thinking behind that?
Their goal with Liability 2.0 is to improve what they call depositor stickiness. Essentially, they want to create a banking experience that keeps customers engaged and coming back for more. This would ultimately allow them to reduce the interest rates they offer on deposits and narrow the gap with the larger banks.
So instead of competing solely on interest rates, they're focusing on building loyalty and creating this kind of comprehensive ecosystem of products and services.
Precisely. They're offering investment options, trading platforms, ASBA facilities for IPO applications, bill payment services, personal loans, and they're even planning to launch credit cards by March 2025.
Wow. It's like they're becoming this one-stop shop for all the financial needs of the informal sector, which is a market with immense potential in India.
Right, and they've already started making adjustments. They've reduced savings account rates by 13 basis points and peak term deposit rates by 25 basis points,
Right.
really laying the groundwork for sustainable growth.
So for our listener, what's the key takeaway from all of this?
Well, here's what stands out to me. EQA Small Finance Bank is not only effectively navigating a really challenging situation in microfinance, but they're also simultaneously building this robust and diversified portfolio for future growth. Their commitment to serving the informal sector and their focus on long-term sustainability make them a really fascinating player in the Indian banking landscape.
Yeah, I completely agree. It's a story of resilience, innovation, and a deep understanding of their target market. And it leaves us with, I think, a thought-provoking question. Could EQA's success in navigating the informal sector provide a blueprint for other financial institutions looking to tap into this vast and often overlooked market?
It's certainly a model worth studying.
That's all the time we have for today's deep dive into EQA Small Finance Bank.
We hope you found this journey through their Q3 FY25 earnings call insightful and engaging. Until next time, keep exploring, keep learning, and keep diving deep.